I think it's going to be a bumpier profile for two reasons in the next couple of months. Firstly, US yields have been really low, but now there's a bit of an adjustment going on in terms of US yields. And the reason for that is that the Federal Reserve will extend quantitative easing into 2021, perhaps at the September FOMC meeting, perhaps at the November meeting, but it's not going to do QE with yield curve control. We think they'll do about 80 billion a month in terms of US Treasury purchases, which restrains US yields but doesn't stop them rising. So we're looking for 10-year US yields to go up to 0.9, and that's a bit of a headwind for riskier assets. The other point is that if we look at the way that COVID has developed, we've still got a very large number of cases around the world, apart from Europe and Northeast Asia. And there's a real genuine risk as we get into the winter in the Northern Hemisphere in November and December that we see a second wave. On balance, I think if we listen to the scientists, we don't think that that second wave is going to be as large as the first wave or as deadly as the first wave, but it will still be sort of something that causes localized lockdowns, social distancing measures. So it just makes it difficult for the recovery to really sort of take off. It's only when we get the vaccine sort of rollout, which we think is going to be Q1, Q2, that then you engage in more bullishness again.
That's a fair way off when we talk about Q1, Q2 again. I want to ask you what that means about the gap with stimulus very much being sought by the markets but not delivered at this stage. It sounds as though you're concerned about a policy mistake if there's too much of a gap that allows momentum to the downside to continue in the economy.
I don't know if it's necessarily a downside momentum. I think if there was downside momentum, then you'd see policymakers galvanized. What it is that the initial phase of the recovery out of the lockdowns is very sort of sharp, but we'll see that pace of recovery decelerating in Q4 and in Q1. And it's not bad enough for policymakers to urgently take extra measures. And on the margin, in some countries like Europe, there's the phasing out of the furlough schemes, so some of the emergency support is being removed. In the US, we've obviously had no extension in terms of the $600 unemployment. We've had a stopgap measure. We are in a deadlocked situation probably till the end of August until we get a fifth fiscal package from Congress. And even then, we think it's going to be $1 trillion, which is a lot, but it's not a game changer for the US economy. So the narrative on the policy front is on the margin, less additions of policy support, and to a degree, some of the measures actually sort of tapering off. So that means that the recovery's got to sustain itself. And if you're in an environment where there's intermittent waves of COVID before the vaccine, that makes the economic data and financial markets somewhat bumpy. And we think that's the profile for the next couple of months.